Welcome to Community CPA YouTube channel. Today, we want to talk about succession planning secrets, how to guide you exit your business without losing half of the money to taxes. So you have spent decades building your own legacy, your own business, but IRS could take half of it. Without a strategic exit planning, your business liquidation will trigger a massive tax crisis that will lead you to lose your hard-earned equity. And don't let your retirement fund become a government windfall just because you did not plan. And we preserve the hard-earned equity for you by navigating between the business liquidation and the tax liability. And we implement strategic entity restructuring, installment sales, charitable trust to shield your asset from heavy levies, heavy taxes. So by prioritizing meticulous documentation and proactive compliance, and we can ensure your transaction remains as a wealth building milestone rather than a preventable financial crisis for you. So this is about succession, about moving forward. So small business owners often talk about, oh, I'm going to retire in 2 years. What does that mean? That means you need to figure out, plan your exit out of your business in 2 years' time. So to avoid the poor exit, and I want you to understand a couple of things here. The sales price is not a wealth number, right? The sales price is not all the dollars that come to your pocket. Most owners focus on valuation, but valuation is only a starting point. The real question is actually how much of the sales price becomes liquid after tax personal wealth. So that doesn't equal to valuation. Federal capital gain rate is what, 20%? But there is another tax rate you have to consider that is called net investment income tax. That is 3.8%. So your 20% will add 3.8%. So that's your tax rate, not just 20%. Of course, you're also going to have ordinary income recapture, state taxes, debt payoff. You have a loan, so you need to pay that off. Oh yeah, you have to pay the closing agency bunch of fees. There's also escrows you need to pay and you haven't really paid. So all of these can drastically reduce the number you put in your pocket. So be aware, sales price is not everything. Deal structure can matter as much as deal price. Yeah, getting a deal price is good, but deal structure is even more important. Two owners, if we say there's two owners, can sell for the same price and walk away with a very different outcome. One of them doesn't pay any taxes, the other one pays through their nose. So that is the structure difference. A stock sale, asset sale, installment sale, deemed asset sale can produce very different tax character, timing, and the state sourcing, buyer-seller economics. So this is why structure should be modeled. Structure should be modeled before you try to look into writing that letter of intent, coming into a purchase or selling agreement. Don't do that. Do your modeling. 2026 is a year that there is no more handshake selling and buying. Don't even imagine that would be the case. 2026, there's a lot of things are very different, and it will produce a punishment to you if you do a casual exit, because the interactions of capital gain rate and net investment income tax, state tax exposure recaptures, purchase price allocation, all of these rules can come in to engineer your deal in such a different way. The tax cost is not just a compliance issue, right? It's not just that, oh, I need to pay taxes, otherwise I get audited. It is not that. The taxes, at the moment you sell your business, it is literally a strategic planning point. You can avoid paying that, or you just pay through your nose. So this is a negotiation issue. It is not just about paying taxes, being in compliance. You're going to be in compliance anyway when you work with professionals. So they will lead you on the path to be compliant, to be so in compliance that if IRS comes around, and they will defend you, right? So the valuation gap normally folks are talking about, thinking, oh, my business is worth $10 million. So is it really worth $10 million? That is really emotional statement. So basically, a business owner, you should have your dream in terms of how much you want to sell, because that is important to have something in your mind that you dream of that amount, whether it's real or not. So that dream includes how much you think your company worth. So a lot of time, emotional factor is so strong, people think their company worth a lot more than what they really are. So those emotional factor is needed. You need that factor to drive you into seeing reality. So the reality will tell you, well, your emotional factor need to be discounted by 50%. So if that is what is, then you got your sales price on hand. You can sell it for this much million. Then from this much million to what go into your pocket, that is a planning. Of course, let's talk about 2026 business environment. This is a time they call that silver tsunami. A lot of people, baby boomers are large populations in US. So this population of people are either passing their business down to their children. If not, then they have to sell. It's not about whether you sell or not. It is about when you will sell. But when will you sell to sell a good price? That is something you need to plan to know when that may come in for you at your best time, because you can't time what the president is going to say and do. So that big environment economy, it is in recession. That is not some choices you can make. So you certainly understand your surrounding. So you understand that for capital gain, a lot of people goes, oh yeah, I'll only pay capital gain tax. Capital gain tax is 20%. I worked in my business for 30 years, so I have a long-term capital gain. Perfect. I approve that what you said is right. But is 20% really is okay? 20% is not enough, because you forgot you have to pay net investment income tax, right? That is 3.8%. So really, you're at 23.8%. Oh, you forgot about your state taxes. Oh yeah, you also forgot about your recapture tax. Your recapture income that need to be taxed at 41%. So all of these things, folks, that comes to you, you need to understand this is today's tax rate, right? So that is one big environment you are in. And the tax is not reducing, and they're just coming up to you. They're set in stone, and you just have to do it. Another environment I want to mention to you is the selling structure, because the selling structure can help you save that capital gain. So what if I tell you that if you structure that so well, you're going to save $10 million? If I say that, what do you think? You go, oh, wow, Ying, great. Tell me, what is that? I want to know more. The statement you just said, I want to know more, just means that you want to do the pre-sale modeling. Really look at what you do. If you are in a new business, but you know you're going to sell it in 2-3 years, you should look at your exit already. By setting up the business, you would already have a plan to go for the future to have that $10 million free money in your pocket. In fact, today I had a client meeting. What we are talking about is a new company. It has such a business content that, and it qualifies for Section 1202. So guess what? If it is qualified for Section 1202, then we will start the company as a C corporation. Folks need to do a C corporation, have proper documentation done, and the shareholders properly defined, because there's a huge money in the future that they are exiting with free. So asset sales structure, the structure becoming very important. Then of course, for the seller, and the seller like to have the selling to be what we call the equity sale and stock sale, because that would drive into an area, lower taxes, possibly have the exemption. So this is what seller wants to do. But for a buyer, they want to buy your asset so they can look at your asset and knowing how much they paid for, so they have a step up in value for the asset as a basis, and then they can do depreciation, amortization on the brand new price. You got that? You see where this becoming beneficial for the buyer. Buyer and the seller could take a very different position. That's why there is a form called 8594 that buyer and the seller need to report to IRS. So IRS will make sure your one transaction are treated the same on both ends. In the government, ultimately they're doing audit compliance to nail down more people who didn't follow the rules and get you to pay. right? Tax dollar is revenue for the government. Is the money that tax dollar is the money used to build that ballrooms in White House. So the tax dollars is what the government entitled. They can take it from you. But of course, they ask you to calculate it. But if you did it all wrong, and then IRS think that you owe, IRS will collect on you. So this is where we want you to understand the business environment, because it's not rosy. And whenever there is a big deficit, the government is running short on cash flow, just like all the business, they cut agencies, and at the same time, they beef up the compliance side, they get more people audited. So that's the environment. Of course, there's another thing in 2026. It's kind of drawing a lot of eyeballs. It is called Qualified Opportunity Fund. So in short, it's QOF. So qualified opportunity funds are the money you sold your company for 10 million, but you dumped all your money into the qualified opportunity fund to invest. So that money, whatever you have a capital gain, before you don't have to pay that capital gain taxes. Now 2026, December 31st, that is the due date for everyone who put that money in the QOF fund need to pay that deferred piece of capital gain. But of course, it stays in the fund, so they still make money. New capital gains are coming out of the money. That new capital gains, if it is more than 10 years, with other small conditions, you don't have to pay that capital gain taxes. So if you really made a lot of money, sold business, got capital gain, look into qualified opportunity fund. You still end up paying the capital gain because December 31st, 2026 is right here. So you end up paying the capital gain, but the money, the capital gain, and all of the money you put into this fund, if it stayed there to invest for 10 years, whatever increase you got there, there's a IRS section, it's called 1400Z, and it just kind of understand the qualified opportunity fund opportunity. This is opportunity. And especially when you just get a windfall of big amount, and that's what you can look into. Of course, I want to give you modern tax toolkit, which is for the people who are thinking of selling their business, right? So, and we want to tell you that these are the things you're supposed to think about. So there are 4 things. The number 4 is on the next slide. So the first 3, number 1 is installment sales. When you do a sales deal, and for buyers, because the lending market is very tight right now, the banks are not comfortable of lending, interest rate is going up. So I always told people that, interest rate can go to double digits, and you're still in the single digits right now, so it's not so bad. But, after midterm and going down to next year, I think the interest rate is going to go to double digits. So, borrowing money is hard. When borrowing money is hard, then the ability of people to buy business from you is going to be hard. People don't have money. They cannot get funded, so they won't buy you. So as a seller, what do you think? To have that installment sale will help out the deal, right? Not only you help out the buyer because it's an installment, so the buyer can take time to pay you, you also help yourself because your capital gain will only be recognized when that portion is paid. The rest of the capital gain is sitting in the back waiting for you to receive it, then you will claim it. So installment sale is definitely a way to go. It is probably the most seen business deals right now on the market for small and the medium-sized business because you just cannot get loan. And getting loan is like pulling, not even teeth, it's pulling all of it out to get a loan. It's just hard. We help clients. Part of our business is also at Community CPA. We help business owners to obtain loans to finish their project. So that process is not easy. It's a lot harder. If I think back 2-3 years ago, it was a lot easier than today. So that environment, think about installment sale, right? The other thing we want you to think about is this charitable remainder trust tool. Basically what this is. Let's say you sold your business for $1 million. But the basis is only $100,000. So that means you have a $900,000 capital gain, right? So if you sell it personally, if you just go ahead and sell it, you will pay $900,000 times 23.8%. That's a federal tax. And then you will go to the state, file state taxes, so you have taxes to pay. You put this $1 million you sold into charitable remainder trust. Then you reinvest the full 1 million, then the tax will just come out to you slowly. So what that does is that charitable trust will have all your million. So you don't have tax consequences because that's a charitable trust. You don't end up paying taxes for it. Basically, the charitable trust had this $100,000 basis that you donated, right? It sold for $1 million. So all of the gains staying in the trust, in the charitable trust. And the agreement says that it will be invested in an investment. Let's say just bought Apple stock. So you will have gains coming out of that investment. That gain and it will come back to you, pay you as the agreement goes. So every time you get that payment, you will pay taxes. So see, you don't pay taxes on this 900,000 capital gain, and you deduct the $100,000 as your charitable donation because that was your basis. Then you receive this money from the charitable remainder trust, so you will be reporting taxes on what you received. Slowly sort of turned you into an installment sales, right? So that is kind of how that works. A lot of time people just say it's CRT. CRT stands for charitable remainder trust, and that is particularly designed for this type of windfall cash tax saving. So you don't end up paying taxes immediately on your 900,000, which is almost about $200,000 taxes you have to. Then the other thing I want to mention to you is earlier I was talking about the opportunity zone reinvestment for deferred gains from a business sale into a new asset. Basically, when you sell your business, you sell one asset, right? You sold an asset, but you literally turn that into another asset, which is this opportunity zone investment. And in this investment, let's still use that $1 million as example. That $900,000 capital gain, and in this situation, the whole million went into the opportunity zone reinvestment. And this whole million going to grow maybe to be 5 million 10 years later. But when you take that out, the whole $5 million out, you're supposed to have a $4 million gain, right? Because that 1 million you put in, let's say that's the base, and you sold 10 years later 5 million, so you got $4 million gain. That gain is tax-free. That is opportunity zone reinvestment deal. But of course, in 2026, December 31st, 2026, the OBBBA rule and made some changes, says that if you put in the $1 million, you still have to pay taxes for the 900,000, the gain that you already got. You cannot defer further on that gain, pay taxes. So, a lot of our investors, instead of taking the $900,000 out, they actually leave the $1 million there. They will just comply with December 31st, 2026 requirement to pay taxes for the 900,000 on capital gain. But you know what my clients would do right now? We will be working the whole year to have capital losses, to realize the capital losses to offset that gain. So you have time to work with it. And whenever you plan, there's always a better way at the other end if you can just believe that tax is not an accidental event. Whether to pay tax or not is a planned event. A lot of people goes, I'll pray to God, I'll go to church this Sunday, pray to God that I don't have any taxes to pay. It's not because you pray to God. It's because God told community CPA that to work really hard for you, and then we just got that done. It's still a human effort. It is your planning. You have to agree. You have to allow community CPA to do it. Then you can enjoy the benefit of it. The last one I want to talk a little bit more with you is building a sales-ready tax shell. So this is the structure piece. We talk about that all the time. And if you are into watching my videos, and you already knew that there's not countless secrets out there in the tax code that you don't know, I don't know, and we don't talk about. It's all there. And the only reason sometimes you don't know is because the level of money you have is not yet reached to that time, to that amount. So, but for baby boomer generation, and whether you have a $100,000 business or a $10 million business, we are facing the same thing. We're getting older, and we are at the time need to think about transition, need to think about exit plan, need to think about selling, liquidation. So those are just normal life path. It is not because you are not good, so you arrive there. It's because you are so great. You're still alive. That's why you have to think about how to exit. I guess if you're not here on earth, why would you even bother with tax code? In heaven, there's no taxes. It only existed on earth. So with that said, really, because it is a necessary path, So I want you to take this in as a necessary doing. You have to do it. You need to consider that. Identify why reorganizing from a C Corp to a S Corp or to LLC at least 2 years prior to exit is critical for asset sale optimization. Why? There's a lot of reason why. So if you have an LLC, if you have an S Corp, or you got a C Corp, you convert it to LLC, I mean, you need to come to the tax professionals and just simply say that, can you look at my business? I'm ready to sell. I want to make sure that I'm qualified to take Section 1202. Some business don't qualify for Section 1202, all right? Like accounting firms, if you want to sell accounting firms, there's no Section 1202. Insurance agency, no. I had a client who come to me a year and a half after he sold her business, and somebody said that she complained to someone that she was paying too much taxes. So then they said that, oh, did you talk to Ying? Have her look at have her look at your deals. I look at her deals. You know how much money she lost? 1.5 million. So sad. There is no way I can help after the deal is done. But it's just sad. 1.5 deserves to have a planning before selling. So here on the slide, I outlined the Section 1202, qualified small business stock, exemptions that can potentially wipe out 10 million. Yeah, I wrote it there so you can follow that paragraph and really make sure you qualify. If you qualify, you have to do it. You cannot, if your nature of the business qualified, there is no fuss about anything. You make yourself qualify. Okay, so make sure that you do this pre-due diligence audit for your business, modeling after what, once you sell, how much I pay, what do I do? So just really map it out. So closing and next step. Many business owners have an unrealistic attachment to the business they created. They think the business will die without them. They think the business will not even exist if they are not existing. I will say that in Chinese, we have a saying that the heroes is not created by the person want to be a hero. It's actually created by the time the need of universe will give us that hero. Actually, the universe giving out that kind of clue for who does what business will be successful to a lot of people, a lot of crowds. But there's only one or two will pick it up and run. You are so sensitive to universe calling, you picked it up and you did it. So that is you, a hero. But anybody else can come in and be a hero too. So do not have the unrealistic attachment to the business, because someone else can come in, do as well as you do. So you wanted to find time to transition. So transition need to happen and trust that the business will survive. I wrote there saying that 未雨绸缪, which means that prepare your umbrella before it rains. So in business, prepare your exit before you really need to exit. I always tell my younger clients in their late 30s or late 40s, I'll tell them that you should do estate planning. Then they go, oh, too young. It's okay. I'm not going to die tomorrow. And then I will say, because you're not going to die tomorrow, because you are young, that is a good time to do. It is important to do it when you are completely have a large distance between the moment you need it to this moment you are having right now. So really don't drag it. It is something that you need to do. So the preparation can cost a lot of money, okay, for your next step. And you want to plan the exit, and you need to mentally know that it will cost money. But a significant tax fix might just cost you $850 to do. So when I say a lot of money, it's also very subjective. For some business, $100,000 is very little money. But for some business, even $1,000 is a lot of money. So it depends on your size, right? That's why when you work with this kind of planning, we look at the size. We look at what fits you, then to give you the plan that you can afford. Like I said, $850 is not a number I made up. It is actually a tax structure formation that how much we charge. So come to Community CPA to plan. I'm not saying that we're the only place you can do, but I am saying that we are a place have so much understanding of where you're coming from and so much compassion, and we've gone through that ourselves. So with that said, and I will leave you with a lot of thinking, and make sure you plan your exit from your business today. All right. So this is our website, communitycpa.com. And you notice that we have this onboard with us button. If you click that button, and you will sign up with us 24/7 whenever you have time through this button, then we will get back to you and get you connected with the right team member to help you out. So we have 6 partners, 2 managers listed on our website. 6 partners were all in different area of practice. So Dr. Howe and one of the partner, and he is legal compliance and the immigration side of work. And Dan Kim, another partner, he's in charge of client service of market development. Juan, specialty in payroll accounting, sales tax. Song, he is our attest partner, handles audit. And Derek is our IT, network architecture and IT partner. Tiffany is our tax manager. Eileen is our accounting and audit manager. And this is YouTube channel. We always deposit all of our webinars into here. And I hope that you will subscribe to our channel so you always get notified what we have for you next. And also, if you like our video, give a thumb up. Last, no responsibility disclaimer. Of course, all our webinars are for educational purposes, and it is not the tax, legal, accounting advice, because those advice need to give to you customized. We need to know who you are before we can finalize what is the advice. And be sure to review any decision with your CPA, your attorney, your tax advisor, or with community CPA before you put that in action. All right, I'll talk to you again